Hello, Business 330, Business Finance. This is Professor Hassey, and I'm speaking to you from Detroit, Michigan. This week, number 6. I'm back in Michigan this week, but all is okay. And rural part of the state of Michigan is rather poor. So we'll manage this video as best as possible. If it becomes unstable and doesn't work very well, I'll just have to send you the information via an email. But let's try and see how this works. This is week 6. Today's date is Thursday. Let me check, July 14th. And we're going to be talking about our assignment number 3, finance, that is due Tuesday, July 19th. And for our online business finance, that is due Sunday, July 17th. But you can have, if you need extra time, this is quite a bit of work on this assignment. You have extra time. If you need it, just let me know. So let's just take a look, first of all, at assignment number 2. I have posted those grades and solutions to Blackboard. And I've given you 2 solution files, one with the Word doc file, which goes over the assignment. But the second file is for some of you who might have some problems with doing the calculations for present and future value. And I've given you a spreadsheet file. And here's what that file looks like. The scores for assignment 2 were quite good, but some of us had just a little bit of problem with the very first question. What is the future value of $10,000 on deposit for 5 years at simple interest? Many of you compounded, or not many of you, but some of you compounded the interest, but it said simple interest. So all you need to do is take the $10,000 times 6%, and for 5 years, interest, principal times interest times time. There's no compounding. In other words, you're not adding interest after every year and then compounding that, because it's simple interest. And I was seeing if the student would catch that. And so the answer is $13,000 with an interest payment of $3,000, which is 6% of $10,000, and then times 5 years is 3,000. So the total amount would be 13,000 for the answer. That's the only real problem any of us had. But if you do have any questions about that work in assignment 2, here's a here's a solution file, which should be able to help you in Excel format. So take a look at that if you like. Okay, here's our Blackboard, and just a couple of points to mention. If you go to the assignment folder, you'll see assignment 2 solutions, but also assignment number 3. And we're going to go over that in just a minute. 2 files for assignment 3, the Word doc file that you do your work from. And the second file is a spreadsheet template. One of the things that assignment 3 has is to do a capital budget analysis. And I have given you the tabs to do that. And also you have some extra credit work for assignment 3. And there's a separate tab to do extra credit work to get some extra points for your work for that assignment. So download that spreadsheet file and you can take a look at that. And also the assignment 3 file folder is there. Again, it's due either on the 17th or the 19th, depending what class you're in. So please look at that. We're going to look at a sample problem in that regard in just a few minutes. So that's the information you need from Blackboard this week. If you go to week 6 and open up the file folder for the week, you'll see our agenda. And this is the file that I'll be reviewing in our video today. Week 6 capital budget analysis, summer 2022. It's a sample problem again, about very similar to assignment 3 and very similar to, with a little bit different format, to the review problems we did last week to calculate net present value and to calculate cash flow. The only difference in addition to this week is you have to determine the weighted average cost of capital, which is chapter 11. But again, the sample and this review should help you do that. It's not very difficult. You just have to understand to get the right pieces of the puzzle to complete the work. So let's take a look at the sample file that we're going to be reviewing today. Okay, here's that review spreadsheet file, and this will be very helpful to you in reviewing our work for week 6 and assignment number 3. We're looking at the capital budget process. Remember last week we talked about net present value and the return analysis, and we talked about calculating the cash flow. Now we're going to put all that together into one little problem to determine capital investment. So the idea is to determine your asset investment, determine the depreciable life, which will determine the amount of years in the investment and your depreciation. You determine from the variables net income by revenues and operating expenses. Then you determine the net project cash flow by adding back in depreciation, determining working capital, and any salvage value in the asset. In other words, what its value at the end of its depreciable life. And then you do the analysis of net present value, internal rate of return, profitability index, and payback. We talked about that last week. The last step is to do a risk analysis. And fortunately, in our class, we don't have to worry about that. That's for MBA study. But the final piece of a capital budget processing is to determine the scenario and sensitivity analysis. But you're not responsible for that here in this class. So we're going to concentrate on the first 5. And I set up a problem in this analysis where we're going to put that together. Here is a project investment of $1 million with all these variables on the left. And then we're going to be taking those variables and determining the cash flow and determining our analysis. Very similar to what you'll be doing in assignment 3. The variables will be a little different. The depreciable life might be a little different, but the format is the same. And that's your job, is to put that together and understand it in assignment 3. But before you do that, you have to determine the cost of capital. In other words, what is it costing the company? If they financed this project today, how much would it cost them in money? And it's all based on 2 things. Number 1 is, what is the capital structure of the company? In other words, what is the mix of assets and, liabilities and equity that fund the assets of the company today? That's called the capital structure. That percentages of debt and equity will drive the weighted average cost of capital, as you can see here. And then the second factor you need, naturally, is what is the cost in the market today of financing? What is the interest rate on debt? What is the current environment for equity using the capital asset pricing model? In other words, what does it cost us to get the money? Once we determine those costs, then we can use the weighted average of the capital structure to determine our discount rate or our cost of money for our analysis in the problem. Okay, so let's take a look at this example of the cost of capital. So we have as the variables debt to assets of 60%. So if our debt is 60% of our assets on the capital structure, that means it has to total 100. That means our equity percentage is 40%. So 60% of the company is financed by debt, 40% is financed by stock and profits, retained earnings. So that's the capital structure. That's the basis by which we determine the weighted average cost of capital. The tax rate for this company is 30%. The interest rate on debt is 9%. So if we have debt at 9% interest and our tax rate is 30%, our after-tax cost of capital would be 9% times 1 minus 30%. In other words, we get to deduct on our taxes 30% of our interest expense. Yes, we have to pay 9% interest to whoever lent us the money, but on our tax return, we get to deduct 30% of that as a tax deduction. For corporations, interest is tax deductible. So if we put that into an equation, we would put equals 0.09 and then multiply that times 1 minus 0.3 or 30%, which is 70%. So times 0.70, and we would get 6.3%. That's our after-tax cost of debt. That 6.3% would go down here. And notice my calculation takes 60%, which is the capital structure of debt for this company, times the after-tax cost of debt, and we get our weighted average cost of capital of 3.78%. So that's our debt of our cost of capital. The equity is a little bit more complicated. It's the capital asset pricing model, as we've talked about before. It's the risk-free interest rate plus the market rate of return minus the risk-free rate, which is called the market premium. And that market premium amount is multiplied by the beta of the company. So for this example, our risk-free rate is 2.5%. That's zero beta in the market. Our market return in the market on average beta, which is 10%. And the beta of the company that we're doing this analysis for is 1.35. In other words, that's the risk in the market of this company. So if we do that math or do that arithmetic, 2.5% plus 10% minus 2.5%, which is 7.5, times 1.35 will give us our cost of equity. So let's put that into an equation. Equals, parentheses, got to put in a couple parentheses here because we're doing a couple calculations. So the percent would be the risk-free rate, which is 0.025 plus, and now we put in another parentheses, the 10%, we can just do that in our heads. 10% market return minus the risk-free rate is 10 minus 2.5, that's 7.5%. So plus the market premium, 0.0750. And then we're multiplying that times the beta of the company, 1.35. And now we have, with that double parentheses, we now have all the information to get that calculation. And it is 12.63%. So 2.5% plus 7.5% times 1.35 is 12.63%. That's the company's cost of equity. If they wanted to attract investors by issuing equity in the market, that's the type of return they would have to give those investors to satisfy their desire to invest with their money. So now we put 12.63% down here, and it takes 40% of that, which is the capital structure of equity. We get 5.05. Add the two together, the weighted average cost after tax cost of debt plus the weighted average cost of equity gives us 8.83%. And that's our cost of capital in this project. If the company would go out and invest this money today, on average, based on their capital structure and market rates and risk, they would have to pay 8.83% for that money. That's your cost of capital. Remember, last week we had the cost of capital being 10% or 11%. Here in this problem, it's 8.83%. And now we take that amount and go to our next tab to our analysis, and there's the 8.83% as our project WACC. So if you remember from chapter 10, when we put together the cash flow analysis, we have variables and we have to put those variables into a capital budget analysis spreadsheet. And that's the spreadsheet I've provided for assignment 3. And we're going to walk through this spreadsheet here, okay? First of all, what's our investment? Our investment is $1 million. So $1 million negative. That's how, remember, this is a cash flow sheet. So there we go. There's $1 million negative. Notice I have formulas already set up for this to do the calculations for us in the arithmetic. In your assignment 3, you're going to have to put in those formulas, but all you're doing is just totaling the columns. next thing we do is, what is the revenue being generated? Well, we can see that the revenue is, they're going to sell 25,000 units a year at $20 a unit. So right here in the first year sales, I'm going to put in equals the amount of units sold this year times the selling price, $20, $500,000. But notice something else happened in this problem. As you can see, notice the inflation rate is 2.5% for this revenue sales price. That means the sales price after year one will increase by 2.5%. And as you can see, that's what it's done. So the spreadsheet automatically takes, so notice it takes these sales in year one and multiplies it times 1.025, 2.5%. And now we've covered for inflation for the life of this project. This is a 10-year project. So we go out 10 years. And if you just take this out further, you see the 10 years right there. Okay. So now we've got revenue covered. Let's see about our expenses. Variable cost, which is a per unit cost. Again, if you look at the variables, they're always given in every problem. $8 is our cost per unit. So we take that $8 in year one and multiply it times the number of units we're producing, 25,000. And there we get our variable costs for the year. And again, the inflation rate for variable costs is a little bit different. It's 2%. So now we're increasing variable costs by 2% every year. Clear as mud, huh? Then we have the next cost of this operation, and that's the fixed costs. Costs that do not change with volume, but they're still expenses. And as you can see, it's $50,000. So here we just type in equals the cell that 50,000 is located in, B13, hit enter, and there's our $50,000 expense. And now just notice inflation is 1% per year. And now we increase our fixed costs by 1% every year. So again, we're projecting revenues and expenses going out 10 years. So we have to account for inflation. Now, if you notice the current inflation numbers now in the real world is about 9%. So this project's got it pretty easy with 2.5%, 2%, and 1% inflation. But those are the inflation related values you have to worry about in your analysis: sales, variable costs, and fixed costs. So we have those now included in our spreadsheet. Then we put in depreciation, which is another expense. Well, they give us in a variable. It's a 10-year project, $1 million investment. So we're depreciating $100,000 a year. So now let's put in 100,000. We don't have to worry about inflation in this expense. And now let's slide that over all the way. Oops. In other words, bringing the $100,000 depreciation every year. So I'm just taking the cell and sliding it down. And there's our $100,000. Oh, one more year, sorry. And there it is, 100,000. So now we've incorporated depreciation in our calculation. And now we have all the expenses for this project: variable costs, fixed costs, depreciation. And so our next line is earnings before taxes. So what this line takes is the revenue and subtracts out the expenses. 500,000 minus 250, 100,000. We're making a profit before taxes of $150,000. Then the next line takes that 30% tax rate times the earnings. It's 45,000 and subtract it. And now we have our net income for the project for every year. 105,000, 110,600, and so on. So now what we've taken is we've determined our net income for the year. Once we determine net income, then we have to determine these additional values down here that we add to cash flow. And notice one has already been calculated for us in the spreadsheet. It's working capital. So in this problem, the variable working capital is 12% of next year's sales. So working capital is additional cash flow, additional cost in assets and liabilities that you have to operate this asset. You guys know what working capital is. If you buy a car and pay $40,000 for a new automobile, is that the end of your cash flow that you have to spend on that car? No, you have to buy gasoline and registration, insurance. You have other obligations associated with that asset. And that's what working capital is. The additional working capital that you need to finance and put together that asset. So the working capital is a rate. It's a rate of sales or revenues. So notice in year 0, to get this asset off the ground, we have to take 12% of the first year's sales, 500,000. So 12% of 500,000 is $60,000. That's additional cash we have to outlay. Then notice in every year, as our revenues increase, we have to increase our working capital to maintain the 12% of the next year's sales. So again, if we take 12% of the difference between 512,005 year 2 and year 1, that's 12,005, take 12% of that, and there's the formula there, it's $1,500. So at the end of year 1, we have accumulated $61,500 of working capital cash flow, which is 12% of the next year's sale. So this continues on every year throughout the life of the project. But then when we get to year 10, the last year, there's no more revenue. Financially speaking, the project is over. So what we have to do now is take 12% of the final year's revenue, 624,431. Oops, sorry. Equals 12% of the final year revenue. So multiply that 12% times the year 10 sales, and we get 74,932 of positive cash flow. Why? Because the project is over. So we're taking all the amounts, 60,000 and all this cash flow coming up to the final year, and that all accumulates to 74,932. So if we add all that back in, the net effect on the project is 0 cash, but we're showing the appropriate cash requirements for working capital in each year of the project. So that's working capital. So you have to be aware of that and include it in your cash flow in your analysis. Another incident is, if you notice in our variables, they tell us in the variables that at the end of its depreciable life, this $1 million asset is going to have a salvage value of $50,000 in year 10. So because we have fully depreciated the asset over its life, and if you remember your accounting at the end of its life, we have fully depreciated, so the asset has 0 value. Well, if we're getting $50,000 in the 10th year, that's a capital gain. So we're going to put that $50,000 and multiply it times 1 minus the tax rate, 1 minus 30%, to get the net after tax gain on the disposal of this $1 million asset. So the tax rate is 30%, 1 minus 30% is 0.7. So we multiply 50,000 times 0.7, and that's $35,000 of additional cash coming in by disposing of the asset at the end of its life. Now, again, remember, in the real world, they might hold on to this asset for 20 years. But as far as doing a capital budget analysis today in year 0, we include the value of the asset at the end of its depreciable life. And in this case, after taxes, it's $35,000. The final piece of the puzzle is we have to add back in depreciation. Remember, depreciation is it's operating expense of the project, but it's a non-cash operating expense. So we can add that back in as positive cash flow down here, all the way across. And there's our 100,000. So now we've determined with our variables, net income. We've now determined its salvage value. We've added back in depreciation. We have accounted for the needs of cash flow for working capital, both going out and then coming back in year 10. And so now we know that we're expending $1,060,000 and we're generating $2.417 million of cash flow off this investment. Pretty good. So what does that tell us in dollars, percent, ratio, in years? Well, now we do the calculations that we learned in chapters 8 and 9. The discounted cash flow. Formula, function, net present value, the interest rate is our cost of capital that we determined, 8.83%. And our values are year 1 through year 10. And once we hit that, it's going to take those cash flows and determine its value in today's dollars. And there it is right there. $1,510,832. So the $2.4 million of cash flow generated over 10 years, discounted back to today when we're making the investment of $1,060,000 at our cost of capital rate of 8.83%, there's the formula there, gives us $1,510,000. We subtract that discounted cash flow from the investment, and there's answer number 1. The net present value is going to be making $450,832. Okay, that's answer 1. Answer 2 is, what is this in a percent? So we bring back formula, function, internal rate of return. So let's find that here. Look for IRR. There it is right there. And all we have to do is paint the values, including year 0, and paint the values through year 10. E21 to O21. So now it's going to take all the years, including year 0, and determine the return in a percent. So we hit done. And now it's calculated for us the percent of 17.03%. Okay. That's our return in a percent. What's our profitability index? Well, it's a ratio. The ratio of the discounted cash flow to the cash flow going out. So that's simple enough to do, equals discounted cash flow divided by, and then put this into a negative, the net cash going out, and we'll get a positive ratio of 1.43%. Cool. Then our final calculation, as you remember from last week, is how many years did it take us to pay back the $1,060,000? So we take $1,060,000 and subtract out the first year, subtract out the second year, the third year, and the fourth year, and we notice we pay back it during year 5, where we have a positive return of $14,730 at the end of the year. So what is that in years? Now we just take the year 4 ending cash flow, getting rid of that minus, and dividing it by year 5 cash flow, and we get a percentage, 0.94. 1, 2, 3, 4.94 years. And that's our payback in years. It's taking us 1, 2, 3, 4, and then 94% of year 5 to pay back the $1,060,000, so 4.94 years. That's our base analysis. So I'm going to save this and turn it back to Blackboard so you have this template on how to do this analysis. What does it tell us? It tells us that yes, or go. This is a good project. We're going to make money. Let's invest it. It's going to show based on all our projections and variables, and all these projections come from many different departments, but the variables are supplied to you, the financial manager. You put them all together and it says, yeah, we're going to make some money. It's costing us almost 9% and we're making about 17%. We're paying back our ratio, and we're paying it back in less than 5 years. It's a good investment. So let's go forward. That's capital budgeting analysis. And let's take a look at the problem for assignment 3. So here's assignment 3, where you have to take these variables, put it into our format, the templates that we've looked at here today and last week, and determine the cost, the project cash flows. Now, the good thing about this problem is you don't have to deal with WACC. It's already given to you. The cost of capital is 9%. Mr. Hassey, why did you review cost of capital? Well, for later on, like our final examination, you're going to have to learn and calculate the cost of capital. So keep that spreadsheet handy. But we now know that the cost of capital is 9%. And then now here are the variables you are to include in your analysis, not the variables in the sample I gave you, these variables. $750,000 investment, 5 years, $150,000 depreciation every year, a salvage value at the end of 5 years of $25,000, a working capital base of 10%, a company tax rate of 22%, units sold, selling price, fixed cost, variable cost. Now you have all the variables to put into this, and you're given the cost of capital is 9. You don't have to calculate it. And now you can put those into the spreadsheet and calculate. And we'll take a look at that spreadsheet in just a minute. Then I give you 3 other extra credit problems, which will be additional 20 points if you get these problems correct. There's 3 of them. They're multiple choice. So if you get those correct, you get an additional 20 points for this work. Don't forget that. That can help you. And here's the template I provided you in assignment 3. There's the spreadsheet all laid out for you. Your job is to take these variables and calculate them out. So the good thing about this is you get all your variables, you get the inflation rate. Notice the inflation rate is the same for sales, variable costs, and fixed costs. A little bit higher, it's a little bit more real world. You already know the cost of capital, so you don't have to calculate that, and that's included there. So your job is to put these together. But notice, everything is blank, and also the formulas are blank. So you're going to have to put in the calculations. You're going to have to put in the calculations. So make sure you're aware of that. That's what you have to do in this project. You're given the variables, you're given the cost of capital. You have to complete this spreadsheet, okay, and put it together. That's your job for assignment 3. So that's assignment 3 for this week. And it will conclude our study of the capital budgeting analysis. So you have to put this spreadsheet together using the template provided in the work, and you're off and running. And you have till next Tuesday if you're in the remote class, and post by next Sunday, July 17th, if you're in the online class. If you have any questions, let me know. I'll be arriving back into California on Saturday from Michigan, knock on wood. And if you have any questions, you can email me or put them in the discussion. Good luck. This is a good thing to know. You're going to be using this a lot in your other classes down the road in your study of business administration. So have a great rest of the week, and we'll talk to you next time. Bye, everybody.